Market rally turning 10 years old over the weekend. Joining us now to talk about the anniversary of the bull run, Howard Silverblatt, senior index analyst at S&P Dow Jones Indices. That things like this don't die of old age, Howard, or they do, and we're just, we're ignoring the past. Is there reason to think we're long in the tooth, or have we had enough rolling corrections to where we keep getting new life?
We haven't had that many corrections, and we are old at this point in time. Historically, for the 13 bulls we've had, this is the oldest one. It's not the strongest one. We did about 17.47%, 17.5% annualized return. Very good historically. It's 10.1. The question is, as you said, where do you go from here? Can we still support the bull, and at what speed can we do? With the key measures obviously being earnings, jobs, and income.
Howard, I've done some calculations where I go back not to 10 years ago, but go back to like the top of in 1999 or 2000 or something, and I do a 19-year look, and the returns are mediocre.
Yeah, I'll go to Y2K as an easy item. I mean, you can use the March 2000 number if you want, and it's 7.5% total return on an annualized basis.
Well, that makes me feel better. I mean, I don't want. It's nice to time it from the 666 low. Yeah. And then it looks like we've just had, this, what'd you say, 17%, but it's like 4%.
Yeah, it's definitely been a shaky ride in there. You had two major recessions. You had not just the IT, but you had the financials. And financials were actually worse and had a bigger impact than the IT situation. It's a long-term situation. We will eventually, get a bear market. The question is, where do we stand now? How are the evaluations? And what are we paying? And what do we expect?
What date do we need to go where we get that 6 or 7% long-term average return? If you go back to 1980, what have we done? Have we done about 6 or 7? Is that all
we've done a little bit more than that? But if you go long-term, okay, back to 1928 or so, it's a little over 10%, about 10.03%. Long-term with dividends, and dividends have been a major component of that. You are in the 7% range if you negate dividends. And dividends obviously are paying a lower yield today because interest rates are lower. So more comes from the capital appreciation. And we still have volatility. We've had corrections, but we have not had that many corrections. The market seems to take a correction, and it's a short time period. It wasn't long ago we were talking about the end of the bull, and the bear was there. We were over 19%. We were closing on the 20% decline numbers. Now we're talking that was 6.5% away from a new high from September. So again, we've got volatile markets, and we've got a lot more information coming out a lot quicker than it used to be. So it's hard to compare information and executability today than, let's say, even in 1980.